So after showing more or less how I backtest mainly model fix and optimize my code, followed by the strategy, I want to explain why I mainly use the higher time frames or big ranges to model my strategy, why I use one logic first of all, and why I decided to use Xauusd, for example. In this situation, first of all, Xauusd is an asset that is very safe to put your money in because, well, it's gold, it's tangible, and is USD. So even though if you don't trust USA in this case as a country, this is 2011 again, and this is COVID. We know that those are two of the events with, or modern events with more weight in the economy and very complex and very hard scenarios for any economist. And a lot of people was not, or they either were losing money or not making money, you know, or scared of trading. So that's why basically I model this, because in worst case scenario, based in data we have available, this is the worst trend I have. This or COVID. All depends on the, as you can see, we have micro ranges, but all depends on how well you manage the overall trend. But per pips, I think this was the worst compared to COVID. And also 28 kind of delivers, I mean 26 delivers some, also some price action, especially here. And this 24. And well, I mean 09, sorry, this is 06. Here's the one that also is a very prolonged trend, but this one is also the 2008 when, well, all the situation started to unfold. So as natural as it is, people will look as gold as a safe asset. As you can see, price only value, it keeps going up for gold. 2011 we went to all-time highs, and now we broke in the past 4 years 3 times the past all-time highs. It just means a lot of liquidity entered the market thanks to the COVID situation. So what we do is basically to model the strategy in the worst case scenarios, so we know, or we have at least confidence in real data that at least the money is being well managed, and in this case diversified among the trend. Because go back to the same testing we're making here in 2013 in this range, and we have that with one logic we can do this, or we can achieve this type of results. And this could go better, like I can still be working with this one for a couple of hours or days and get better results in overall 20 years. But the idea is also to not trust everything in the main logic. Like, this is just the base of a model. The idea is that if you see the market, you will see that we have a lot of trending cycles, but also with huge retracements. That's what trading economy, or assets that have weight in the economy or in important sectors like manufacture, technology, luxury is also a very important one. This all has a weight in why price will trend or not. Like, you're not looking for stocks or bonds or something that you want to yield. Like, you want to go, you want it to go up. Here you want the volatility and all the mixed data and the wicks and all the price action that tells you that you're getting manipulated. But it's a reality that this is how markets work. This is how economy looks, basically. So pretty much your model is prepared for any economic situation that we already have at least the data. And for future scenarios, you have a lot of also trading ranges. You have a lot of information, a lot of tools like the strategy tester to take action and don't leave things just to the random stuff or to what, because your eye also will lie you, or Excel will also tell you something, but the reality is execution is what matters. And the only thing is using the strategy tester and the ticks will save a lot of time. So I recommend that you start with higher ranges, higher time frames, because if you model the biggest range and you know that for a fact that you can hold, for example, me that I'm counter trending, if I know that I can hold this range, well, I just need to micromanage. For example, this is a very easy range. Let me just zoom in. Like, this $100 range, and you're getting at least 36% retracement. Like, for long term, if you want to diversify and keep margin well distributed among big trends and keep it safe, your money in all situations, I recommend to keep it 30%, 35% of the retracement, so you can average the closing. If not, if you add risk, and for example, if you manage your risk 100% here, like your margin call will be, if you pass $100 move, well, in this situation, you can go for bigger lots, and instead of 30% retracement, you will need 5 or 10% or even lower. Everything is a matter of what you want to do, you know, what you want to trade. And pretty much I go for higher time frames and I start lowering. Like the more I lower the time frame, the higher is the risk, because I cannot predict. I'm not trying to predict anyways, but I cannot predict the conduct of, let's go to 1 minute chart. Like, just look at this. This is just, I cannot even zoom anymore. Like, this is just one day. Like, this is crazy. It's just up and down. But if I zoom out the 4 hour, like, really nothing happened, you know? So pretty much if you are going for lower time frames, you're pushing the market, you know? So you're pushing the market here because nothing is happening. But then at one point, this was due to the news, but at one point something will happen that you will be stuck here. So if you're not ready to manage the trend, you're only fitted for ranges. So you need to be more careful on how you trade. But if you want to create a model that is managed 100% automatic, you need to be able to hold big trends. Like this one, for example, was the last all-time high broke, and I sold this spike thanks to being trading 24/7. It was a very, very good trade, very good cycle. So it's a matter of chasing opportunities, but with premium setups. So the more you chase the market, the more risk you're adding to your, in this case, to your model. So keep it low, low risk, but high time frame. So the data will be more effective. You will have better data and better tests in this case. Because if you try to do what we're trying to do, but with 1 minute time frame or patterns or something like that, it won't work. Like, just look at 4 hour time frame. So everything, that's why everyone blames manipulation or stop loss hunt or stuff like that, because they are just positioning themselves for a percentage of loss, percentage, for example, a fixed percent loss here, but they're not taking in mind that price will do whatever the fuck the price wants. So like this $6, $7, that's what it's taking you out of the market. And instead of you locking your 5% here to one price, you should be diversifying this just in case price goes here. Your 5% total risk is up here, not here, and you're holding the drawdown. No, your 5%, you start 0% risk, and if price starts going up, you max out your 5% here. Why? Because in case market reverses, you're here already. You're positioning yourself. The more price is going up, the more you are adding to the volume of trading. So when market reverses, you will have a very good trade here that you don't have position there because ALGO will do it, and you don't have to guess or play the probabilities game or, let's see, here all-time high broke or lower low or Asia session. No, whatever the price will do, it will go up and down all the time. You will trade it because you're positioning yourself smarter. You're using algos to position smarter. Instead of locking your 5% at one price, you're diversifying in a range. So price, if it keeps going up, you don't mind because your 5% can be here, but if price goes here, then we'll retrace again. Like, just look at the chart. Like, I'm not lying, it's just in front of you. Like, every time price goes up, it will retrace at least something, like at least something. And that's why you need the strategy tester and a code, so you know how much of the retracement is needed. And you do that in small ranges, but with high time frames. And then you go from small ranges, from months, you go to years, and then you add more years or more months, or you start testing like I do now, only in a specific drops, so you can balance faster the whole drop. Because I know what I want to do with the side logics, with the scalpers, with swing trading and the intra positions, you know. So this is a very basic sauce, but it's very effective, and I can vouch for it because it's working for me since 2021, and I'm making good returns, stable returns, and very 100% automatic and very safe based on that. Because if we go back to 2021 to here today, like, everyone is losing money. Like, very few people have tracking record or positive tracking record starting in 2021, and I have it. So this is something I can vouch. So just look at the range that I've been trading with my algo without touching it, just using the backtesting tool. 147% return, very solid. If you want to verify, you can go to my page, davile.com, and go to results, and here you have all the information that it's needed for, in this case, my long-term portfolio, because I have higher yielding strategies, but this is the main model. That's why I recommend you to start with something that you can control and you can backtest. Here are all the broker statements in case my work is not enough, and the progress. So as you can see, it's a very nice curve. no negative months up today. So just keep it simple.